Silver just went through one of the ugliest whipsaws in modern history, and the rebound is happening in a market that is still structurally tight. That combination is explosive in both directions. So, in this video, I'm going to walk you through what just happened, why the rebound is happening right now, and the trapdoor that could open next when everyone thinks the danger is over. Alright, let's talk numbers because vibes don't pay the bills. From recent market updates, gold ripped higher again and pushed back toward the 5,000 neighborhood after that brutal two-day flush. Silver is the one acting like it drank an espresso and then stole the whole machine. It's the best performer on the board right now. And it's not close. By the time most people wake up and check their apps, the narrative will already be written for them. Metals rebound. Crisis over. But if you look at the actual move, you realize we're still living inside the aftershock of a historic liquidation. Silver climbed back into the $90 zone with intraday spikes that feel like somebody is flicking a light switch. Gold pushed above 5,000 again after printing a low that shocked a lot of people who thought gold doesn't do that. Platinum and palladium joined the party too. Because when money is scared and the dollar is wobbling, the whole complex can catch a bid. Here's the problem. When everything is green after a bloodbath, people relax. That's exactly when the market likes to do something nasty. Now, I'm not here to cheerlead a price target. I'm here to translate the mechanics because silver is not just a shiny rock. Silver is a battlefield where leverage, liquidity, industrial demand, and politics all punch each other in the mouth. So what lit the match? You had a cocktail of catalysts, and if you only pick one, you'll misunderstand the whole move. First, the macro backdrop. Safe haven demand came roaring back after geopolitical headlines started flashing again. When the world gets twitchy, capital looks for stuff that isn't somebody else's liability. That's gold's classic lane, but silver rides shotgun because it's cheaper per ounce and it's more volatile, which attracts the adrenaline crowd. And just to underline how fast the mood changed, look at the sequencing. Early in the week, traders were acting like the scare was over, like risk was back on, like the coast was clear. Then the headlines flipped, and the same people who were yawning suddenly wanted safety again. Gold responded the way gold does. It snapped higher in a hurry. One of those days that reminds you it's still money in a crisis. Silver followed, but it followed like a rubber band. Because silver doesn't walk, it sprints. Here's why that matters. When gold rebounds hard, it pulls in allocators who are late. When silver rebounds hard, it pulls in speculators who are impatient. Those are different crowds and they behave differently. The allocator buys and holds. The speculator buys and chases. That's how you get spikes that overshoot. Now add the calendar problem. When economic data is delayed or markets are waiting on a key number, liquidity can get weird. People don't want to commit size. They want to see the print first. That creates thin pockets where price can jump through levels like they aren't there. And when the print finally hits, the move can reverse just as fast. That's a recipe for stop runs, not for calm investing. So if you're watching silver right now thinking, it's back, we're safe, I want you to remember this. The same conditions that create a face-ripping rally can also create a face-ripping reversal. That's not fear-mongering. That's the contract you sign when you play in a market this volatile. And that's why I keep repeating, don't confuse a bounce with stability. The bounce is just price reacting. Stability is when the market can take bad news without collapsing. We are not there yet. Not even close for silver. Second, the dollar softened. And you don't need to be a wizard to understand why that matters. Metals are priced in dollars. When the dollar backs off, the same ounce looks cheaper to buyers using other currencies. So demand can jump even if nothing changed physically. Third, you had policy headlines about building a strategic stockpile of critical minerals for corporate use. That's not a small signal. That's the government basically admitting out loud that supply chains are a national security issue. Now, even when silver isn't named in a headline, the market starts thinking, what counts as critical when you're building a modern economy? Electricity, defense, communications, solar, data centers. Silver touches all of that. Fourth, across the Pacific, you saw messaging that paints a picture of a long game around currency power. Talk about wanting a currency that's widely used in trade and finance, and the ambition to be treated like reserve-grade money. Whether you think that's realistic soon or not, the market hears competition for monetary influence. And competition for monetary influence tends to make people want hard assets. But, and here's where I'm going to push back on the lazy explanation, this wasn't only natural market forces, it wasn't just psychology and profit-taking. There's a plumbing issue in the metals market that keeps getting glossed over. That plumbing issue is leverage. Silver didn't just fall because people got nervous. It fell because the system forced selling. And forced selling is not the same thing as someone choosing to take profit. Based on recently published margin updates, the big futures exchange raised margin requirements after that violent plunge, and those changes kicked in almost immediately. That sounds boring until you realize margin is basically the oxygen supply for leveraged traders. Reduce oxygen and people pass out. When margin requirements go up, traders have two options: wire in more cash or cut the position. And when you're in the middle of a fast drop, most people can't wire cash fast enough, so they sell. And that selling creates more downside, which triggers more margin calls, which forces more selling. That's not market sentiment, that's a feedback loop. And silver is the perfect candidate for that kind of chaos because it's smaller than gold. It trades thinner in certain windows, and it's full of participants who love leverage because it moves. When it moves against them, it moves like a falling piano. Now here's a quick piece of context people forget. This movie has played before. Different decade, different headlines, same human behavior. In the early 80s, rules changed and silver collapsed. In the aftermath of the financial crisis, silver ripped, margins tightened, and the air came out fast. And in recent years, we've watched smaller versions of the same thing. Parabolic run, crowded positioning, then a violent reset that feels unfair to anyone who wasn't prepared for it. The details change, but the pattern rhymes. Fast run-ups invite leverage. Leverage invites forced selling, and forced selling rewrites the chart in minutes. So yes, the catalyst this time might look like geopolitics, a policy headline, or a central bank narrative. But the mechanics that turn a shove into a landslide are almost always the same: leverage, liquidity, and forced action. Now let's talk about the part nobody wants to admit. The crash didn't magically create new metal. It didn't add ounces to the ground. It didn't turn on a silver faucet. It didn't reduce the amount of silver needed for solar, electronics, and electrification. It just reset positioning. That's why the rebound matters. A positioning reset can cool speculation. It can clean out weak hands. But if the physical side is tight, price tends to reassert, and the physical side has been tight for years. From the publicly available supply and demand forecasts floating around right now, the silver market has been running deficits, meaning total demand exceeding total supply again and again. And here's what makes that hard to fix. A huge chunk of silver production is a byproduct of mining other metals. So even if silver goes vertical, miners can't just snap their fingers and double output. It's not like turning up a volume knob. Plus, the demand stack is not a single pillar. Solar build-out alone can chew through well over 100 million ounces in a year, and EVs can add tens of millions more, and grid upgrades and data centers stack on top. That's not investor mood, that's industrial math. And the reason industrial math matters is because factories don't care if your chart looks overbought. They care if they can source material at a predictable price. That's the fundamental tension under the whole chart. A metal that the world keeps needing more of with supply that can't respond quickly. Trading in a market structure that is basically addicted to leverage. So when people ask, are we going to see 100 by Friday? I hear a different question underneath it. Is the market about to squeeze again, or is the rebound a fake out? Let's walk through the sequence that got us here because the sequence matters. We had a parabolic run. Everybody and their cousins suddenly had an opinion on precious metals. The get-rich crowd piled in. The end-of-the-world crowd piled in. The serious allocators piled in. The momentum funds piled in. And when positioning gets crowded, it doesn't take much to tip it over. Then we got a sharp 2-day drop that for many traders felt impossible. One day of carnage, then another day of follow-through. Silver logged one of its worst days on record. Gold put up one of its ugliest sessions in decades. The speed of the move mattered more than the size. Why? Because speed triggers systems, stops, volatility controls, margin, risk limits. When the tape moves too fast, machines start selling because they're programmed to survive, not to be right. Then after the washout, we got the rebound. Big, fast, and aggressive. And that is where the story gets interesting. A rebound like this can mean two things. One, the market found real buyers, people with cash who see value, people who missed the run and were waiting for a flush, industrial players locking in supply, long-term allocators who don't care about daily candles. Two, it can be a dead cat bounce driven by short covering and mean reversion before the next leg down. So how do we tell the difference? You watch the drivers that don't care about your feelings. You watch the dollar. You watch real yields. You watch risk appetite. You watch physical premiums in key regions. You watch inventory trends. You watch how the market behaves when Asia opens and when New York opens. You watch whether dips get bought immediately or whether buyers hesitate. And you watch the narrative. Because when the narrative becomes too tidy, when everybody agrees on the same explanation, that's when you should be suspicious. Right now, the tidy explanation is, there was a run, it got crowded, a hawkish signal strengthened the dollar, everyone deleveraged, now we're bouncing, all good. That's a clean story. It's also incomplete. Here's the part that makes me uneasy. The rebound is happening while the same structural issues are still in place. Supply constraints, strategic stockpiling talk, big industrial demand, geopolitical uncertainty. And now on top of that, the market has proof that margin policy can change quickly when volatility spikes. That means the next time silver starts screaming upward, the market will remember how the trap worked on the way down. That memory changes behavior. It makes rallies sharper and more violent because people either rush in early or they refuse to use leverage. Either way, volatility increases. Now, before you think I'm here to tell you it's only up from here, I'm not. Silver can still punch you in the throat. It's famous for it. And I'm going to give you the skeptical angle too because you need it. The skeptical angle is demand destruction. At very high prices, industries start looking for substitutes. They thrift, they redesign, they reduce usage per unit. Solar manufacturers have been actively trying to cut silver content per panel for years. When silver becomes a big chunk of production cost instead of a rounding error, engineers get very motivated. So yes, there is a world where silver's price surge accelerates substitution and slows future demand growth. That doesn't happen overnight, but it's real. And it's one of the reasons I don't buy the idea that deficits guarantee straight-line upside. Markets are messier than that. But here's the counter to the counter. Substitution takes time, and the demand stack is broader than one industry. EVs use more silver than traditional cars because of electronics and power management. Grid upgrades require silver. Data centers and high-end electronics pull silver. Defense and aerospace pull silver. And a lot of that demand isn't optional. So we're looking at a tug-of-war. Tight supply and strategic urgency on one side, substitution and volatility blow-ups on the other. And in a tug-of-war, the rope doesn't move smoothly. It snaps back, it burns hands, people fall. That's silver. Now let's talk about the retail angle because it matters for price action and it matters for your sanity. During big moves, you get waves of new participants. Some buy physical, some buy ETFs, some buy options, some buy leverage derivatives because they want a dopamine hit. And when the move goes against them, they don't just lose money. They become forced sellers. We saw stories of people turning a decent win into a disaster in a matter of hours because they were levered in futures or leveraged products. And I'm not saying that to dunk on anybody. I'm saying it because it's the recurring lesson in every metal mania. Leverage is a knife. It cuts both ways. Usually it cuts you. If you're successful, share your success story in the comments so others can stay motivated. And if you got burned, you can share that too. No shame because somebody else needs to hear it before they make the same mistake. Now I want to pivot to something a lot of people miss, liquidity on the ground, because the paper price you see on your screen is not always the price you can actually transact at when the world is stressed. Local coin shops, dealers, and wholesalers can choke up during extreme volatility. They may stop buying certain items. They may widen spreads. They may close early to assess inventory risk. And if you've never lived through a period where physical premiums go wild, you might not understand how quickly the retail market can disconnect from the quote. That's why I always tell people don't build a plan that assumes perfect liquidity at all times. The best plan is one that still works when the market is messy. So, let me give you a real practical example of how that plays out without turning this into a product pitch. When volatility spikes, big bars can become harder to move for some sellers because the buyer pool shrinks. Smaller denominations can be easier to transact. Certain classic forms of constitutional coinage can trade differently because people know what they are and because they're fractional and widely recognized. That doesn't mean only buy small. It means understand your exit options before you need them. Now, I'm going to show you a simple thing I picked up recently from a local coin shop. Not because it's magical, but because it illustrates the point. I grabbed a handful of old dimes, classic fractional silver coins. Nothing fancy, just clean, recognizable pieces that are easy to store and easy to trade in smaller amounts. I like that kind of flexibility, especially when the market is acting like it's on a roller coaster. And here's the weird part. Even when headlines are screaming about silver, you can sometimes still find pockets of mispricing in the real world because retail is slower than futures. That's not guaranteed, but it happens. And if you're patient, you can take advantage of it. Now back to the big picture because the big picture is where the cliffhanger lives. The question isn't will silver hit 100? The question is what happens after the rebound if the next headline hits at the wrong time? Because that's the setup. The market is hypersensitive right now. It just got shaken. Liquidity is thinner than people realize, and the macro calendar is loaded. You've got data releases that influence rate expectations. You've got geopolitical risks that can flare without warning. You've got currency narratives that can shift quickly, and you've got positioning that is trying to rebuild itself after being blown out. That means the next catalyst, positive or negative, can produce an outsized move. And here's the part I want you to really sit with. When a market survives a historic flush and then rebounds hard, it often becomes more dangerous, not less, because confidence returns faster than stability. People start thinking the worst is over. They size up, They lever up, they chase, and then one little shove sends them back down the stairs. So, what do you do with that? You don't need to predict every tick. You need rules. Rule 1, don't risk money you can't afford to be wrong with in a market that can move 10% in a day. Rule 2, if you're going to be in this space, know whether you're trading a price swing or building a long-term position. Mixing those two mindsets is how people blow up. Rule 3, understand the difference between paper exposure and physical exposure. They behave differently under stress. Rule 4, if you're using leverage, size it like you're wrong, because you will be wrong sometimes. Everybody is. Now, let's zoom in on the policy angle, because it's one of the drivers that can keep this story alive. A strategic mineral stockpile is not a vibe. It's a budget line. It's an institutional signal. It says the state is willing to allocate capital to secure materials that it believes it can't rely on the market to provide smoothly. And when you pair that with the reality that refining, processing, and mining are concentrated in certain places, you get a geopolitical commodity premium. Even if silver isn't the headline commodity today, the whole theme supports the metals complex. Scarcity plus security equals higher willingness to pay. Now, let's talk about the currency ambition messaging, because it's being interpreted in a lot of ways. Some people hear reserve currency talk and assume an immediate overthrow of the dollar. That's not how this works. Reserve status is about deep markets, trust, capital mobility, and a whole set of boring plumbing factors that take time. So I'm skeptical of the idea that one statement flips the world overnight. It doesn't. But the market doesn't need overnight change. The market only needs a reason to price a trend. If global actors even marginally diversify reserves, even marginally shift trade settlement, even marginally increase gold holdings, that can create flows that support metals. It doesn't have to be a revolution. It can be a slow leak, and slow leaks matter when supply is already tight. Now, let's address the elephant in the room. Is this manipulated? Here's my honest answer. Markets are engineered in the sense that rules and incentives shape behavior. Margin policy is engineering. Position limits are engineering. Liquidity provision is engineering. Dealer hedging is engineering. That doesn't require a smoky room. It just requires a system. Could there be bad actors? Sure, in any market. But you don't need a grand conspiracy to explain a liquidation cascade. You need leverage, tight liquidity, and a rule change at the wrong moment. So instead of obsessing over villains, focus on the mechanisms. Mechanisms are predictable. People are emotional. The combination creates opportunity and pain. Now you might be thinking, okay, cool. Tell me what happens next. I can't give you certainty. Nobody can. But I can give you scenarios. Scenario 1, the rebound sticks, silver grinds higher, and we get another surge toward the previous highs as the market realizes the structural tightness didn't go away. In that world, 100 is not crazy. It's a psychological magnet. Scenario 2, the rebound fails, the dollar strengthens again, risk assets wobble, and silver retests the lows as leverage traders get shaken out a second time. In that world, you'll hear a lot of people suddenly say they always knew silver was a bad idea. Scenario 3, we chop violently. Up 10, down 8, up 9, down 7. A volatility regime where the market doesn't trend cleanly, it just punishes impatience. And here's the cliffhanger. The most likely scenario in the near term might be the messiest one. Because after a shock, markets often need time to find a new equilibrium. That means whipsaws. So if your plan requires a straight line, your plan is wrong. Now, to keep the progression clean, let's circle back to the what happened beat in a tight timeline. We had a run to extreme levels. We had a sudden air pocket where buyers vanished and margin pressure hit. We had a policy-driven margin increase that amplified forced selling. We had a narrative catalyst around central banking and geopolitics that spooked the crowd. We had a rebound as fears subsided and value buyers stepped in. And now we're sitting in the uncomfortable middle where everybody wants to be right quickly. This is where discipline matters. If you're a long-term holder, you're probably not phased the way traders are. But even long-term holders can make dumb decisions when volatility hits. They can panic sell at the lows, or they can chase at the highs. The market doesn't care whether your intentions are long-term. It only cares what you do today. So I want you to ask yourself a simple question. If silver drops 15% tomorrow, do you have a plan? If silver jumps 15% tomorrow, do you have a plan? If the answer is, I'll figure it out, that's not a plan. That's a hope. And hope is expensive. Now, I'm going to tell you what I'm watching that could change the story fast. 1, the dollar. If the dollar rips higher, metals can get slapped again. Not because silver becomes less useful, but because flows change. 2, real rates. If the market starts pricing higher real yields, it competes with non-yielding assets. That pressure can matter in the short run. 3, liquidity in the futures market. Watch volume. Watch open interest. Watch whether rallies are built on new buying or on short covering. The character of the move matters more than the headline percent. 4. Physical premiums and delivery signals. If physical stays tight while paper whips around, that's a clue. 5. Policy headlines. Strategic stockpiles, export restrictions, sanctions, geopolitical flare-ups. These can hit when you least expect it, and silver reacts faster than gold sometimes because it's smaller. Now another quick thing. If you want deeper dives, we do have members-only videos that are produced by a separate team with more research. Those are only for premium members, and the join link is in the description. If you're serious and you want that extra layer, it's there. All right, let's go back to the CoinShop beat because it's a perfect microcosm of the larger issue, liquidity and psychology. When prices crash, people suddenly care about liquidity. They ask, can I sell? They ask, will anyone buy? That's a fair question. The answer is, it depends on what you have, who you're selling to, and what the market is doing that day. During calm periods, most products are liquid enough. During chaos, liquidity becomes selective. Small common items stay easier. Big niche items can become harder. Dealers manage risk by controlling inventory. So if you're stacking is fine. Just stack with intention. For me, that intention looks like having a mix, some fractional, some larger pieces if you want, but not so much in any single form that you're trapped. And I'm saying that because I've watched people get trapped in weird ways, like holding a product that nobody wants at the moment they need cash. Now the twist is this. The very fact that liquidity gets weird during spikes is part of what can push prices higher later. When retail demand surges and supply at the dealer level is constrained, premiums jump. That can feed the narrative, which pulls in more buyers, which tightens the retail market further. It's like a crowd trying to squeeze through one doorway. That's why you see these periods where people argue online about spot price versus what I can actually buy it for. Both can be true. The paper quote can be one thing while the street price is another, and that gap tells you something about stress in the system. Now let's address the Buy Friday hype specifically because it's everywhere. Could silver move $10 in a week? Yes. We just watched it do bigger swings than that. So the price target is not the crazy part. The crazy part is thinking it will happen smoothly. If silver goes for 100 quickly, it probably won't be a gentle stair step. It'll be a shove. It'll be a squeeze. It'll be a headline. And then it could be a snapback. So if you're going to play that game, play it with eyes open. And if you're not going to play that game, don't let the hype make you feel like you're missing out. Missing out is better than being forced out. Now, here's the cliffhanger I promised. The next big move might not come from silver itself.